50,000. That number flashed across trading screens on February 6, 2026, and for a moment, Wall Street paused. The Dow Jones Industrial Average had just made history. But here's the thing about round numbers. They're psychological milestones, not financial ones. What matters is what's underneath that headline. And today, we're going to show you exactly that. Welcome to Money Moves Daily. I'm breaking down what Dow 50,000 actually signals about your money, and whether this rally has room to run. Before we go any further, remember, this is not financial advice. Always consult with a qualified financial advisor before making investment decisions. Past performance does not guarantee future results. Now, let me tell you what most headlines aren't telling you. This isn't just about one number getting bigger. Something fundamentally shifted in how this market is behaving. For the past 2 years, a handful of tech giants drove almost all the gains. The Magnificent Seven dominated everything. But this rally? It's different. The gains are spreading. And that shift, from narrow leadership to broad participation, is exactly what separates sustainable rallies from fragile ones. Let's break down what the data actually shows. First, let's understand what the Dow actually is. The Dow Jones Industrial Average tracks just 30 blue-chip American companies. It's not the whole market, not even close. Unlike the S&P 500, which is weighted by company size, the Dow is price-weighted. That means a stock's price per share determines its influence, not the company's total value. So when we see the Dow hit milestones, we're watching a specific slice of corporate America. Financials, industrials, healthcare giants, and some tech leaders moving together. Now here's some historical perspective. The Dow first crossed 1,000 back in 1972. It took 27 years to reach 10,000 in 1999. Another 18 years to hit 20,000. From 20,000 to 40,000 took just 7 years. And then from 40,000 to 50,000? Under 2 years. The acceleration is striking, and it raises important questions. Is this sustainable growth driven by genuine earnings expansion? Or is it a valuation bubble inflated by easy money and speculation? The answer, as usual, lies somewhere in between. What makes this milestone particularly interesting is the composition of the rally. For the past 2 years, mega-cap technology stocks dominated returns almost completely. The so-called Magnificent Seven, those AI-powered tech behemoths, accounted for an outsized share of index gains. Everything else lagged behind considerably. But something changed in late 2025 and early 2026. The rally started broadening. Financials woke up. Industrials started moving. Healthcare stocks found buyers. This broadening is exactly what market technicians look for when assessing rally quality. When more stocks participate, the foundation becomes sturdier. Here's the headline number. The Dow Jones Industrial Average closed at 50,115, 67 on February 6, 2026. That single session saw a surge of 1,200 points, a remarkable move. The S&P 500, which captures a much broader slice of the market, ended that same session at 6,932.30. That's a gain of 97% in a single day. According to CNBC's reporting, it wasn't just the tech sector driving gains. Financial stocks, industrial companies, and healthcare names all contributed meaningfully to the advance. Matt Dimitrisin, Chief Investment Officer at Composition Wealth, put it directly, quote, "The positives of the Dow getting to that new milestone is it's showing we're seeing a broadening in the market." He continued, "It's not just tech stocks and AI. We're seeing more broader financial and industrial and healthcare companies starting to become more broadly bought and recognized." This market breadth improvement matters enormously for sustainability. When gains concentrate in just a few names, the rally becomes vulnerable to sector-specific shocks. Looking ahead, Goldman Sachs projects the S&P 500 to deliver a 12% total return for 2026. That's their base case. Optimistic but not euphoric. Oppenheimer's outlook is even more bullish. They forecast S&P 500 earnings reaching $305 per share, with a year-end price target of $8,100, significantly above current levels. But here's where the bulls and bears diverge sharply. Morningstar notes that the S&P 500 is currently trading at 46 times cyclically adjusted earnings, near historical extremes. That metric, known as the Shiller P or CAPE ratio, smooths out earnings over a decade. At 46, we're in territory that has historically preceded below-average returns. Now, historically does not mean inevitably. Markets have stayed expensive for extended periods before, but elevated valuations do compress the margin for error going forward. Morningstar's February outlook highlights another important shift. Market leadership is rotating from mega-cap tech towards small-cap and mid-cap stocks, plus financials and industrials. This rotation matters for portfolio construction. If you've been overweight in the big tech names, the easy gains from that positioning may be behind you. Small and mid-cap stocks, which underperformed dramatically in 2023 and 2024, now offer relatively better valuations. The valuation gap has widened to unusual levels. Market analysts quoted by 24/7 Wall Street called the 50,000 threshold a psychological and symbolic triumph for the American economy. But psychology cuts both ways. Round numbers can create anchoring effects. Investors might view 50,000 as too high and sell, or view dips below it as buying opportunities. Neither reaction is rational, but both are common. What drives markets ultimately isn't psychology, it's earnings. And earnings growth has remained solid, supported in part by AI-driven productivity improvements across sectors. The artificial intelligence revolution isn't just about tech stocks anymore. Banks are using AI for risk assessment. Healthcare companies are accelerating drug discovery. Manufacturers are optimizing supply chains. This broader AI adoption explains part of why the rally is finally spreading beyond pure tech plays. The productivity benefits are flowing through the entire economy. The Federal Reserve's stance matters too. After aggressive rate hikes in 2022 and 2023, the Fed has been on pause. Markets are pricing in potential cuts later in 2026. Rate cuts, if they materialize, would provide additional tailwinds for stocks. Lower borrowing costs tend to boost corporate profits and make equities relatively more attractive versus bonds. But nothing is certain. Inflation has been sticky in certain categories. The Fed has emphasized data dependence, meaning they'll react to incoming numbers, not stick to a preset path. One headwind worth noting. 2026 is a midterm election year. Historically, markets have experienced above-average volatility in midterm years before typically rallying into year-end. That historical pattern isn't a guarantee, but it suggests investors should prepare for choppier conditions in the months ahead. Volatility creates both risks and opportunities. The debate between bulls and bears essentially comes down to this. Bulls see earnings growth, broadening participation, and AI tailwinds. Bears see stretched valuations and complacency. Both sides have valid points. The market can remain expensive while still grinding higher, or valuations can contract suddenly if growth disappoints. History offers examples of both outcomes. What we know for certain is this. The Dow at 50,000 reflects genuine progress in corporate earnings over decades. American businesses have created extraordinary value for shareholders. From 1972 to 2026, that's 54 years of compounding. A dollar invested in the Dow in 1972 would be worth multiples of its original value today, even adjusted for inflation. That long-term perspective is crucial. Short-term volatility is noise. The direction of markets over decades has been unmistakably upward, though past performance doesn't guarantee future results. For investors worried about buying at the top, consider this. The Dow has hit all-time highs thousands of times throughout history. Every previous high was eventually exceeded by a new one. That said, timing still matters for your experience as an investor. Buying at peaks means potentially waiting longer to see gains. Those who bought at the 2000 peak waited years to recover. The Japanese Nikkei index, for comparison, hit its all-time high in 1989 and took over 30 years to reclaim it. Extreme valuations can lead to lost decades in some markets. The United States has structural advantages: innovation culture, deep capital markets, rule of law, that other markets lack. But exceptionalism can breed overconfidence if taken too far. So what does this all mean for your portfolio? Let me walk through some practical considerations. First, this milestone should prompt a portfolio review, not a panic response. If you've been heavily concentrated in mega-cap tech stocks, the broadening rally might be your signal to rebalance. Consider whether your allocation still matches your goals and risk tolerance. Small and mid-cap stocks have historically offered higher returns with higher volatility. If your time horizon is long enough, the current valuation gap may present opportunity. Financial sector stocks, Banks, insurers, asset managers tend to benefit from steeper yield curves and economic expansion. Consider whether you have appropriate exposure there. Industrial and infrastructure names may benefit from reshoring trends and government spending on manufacturing capacity. This theme could have multi-year legs beyond just market momentum. Healthcare has been a laggard but shows improving fundamentals. An aging population creates structural demand. AI applications in drug discovery could accelerate innovation timelines. Whatever you do, resist the urge to make dramatic moves based on round number milestones. The Dow hitting 50,000 tells you nothing about where it will be next month or next year. Here are specific actions to consider. Review your current allocation across market caps. If you're 80% large cap, the rotation thesis suggests diversifying towards smaller names may be prudent. Check your sector exposure. Many investors are unknowingly overweight technology because index funds are so tech-heavy. Deliberately adding financials or industrials can improve balance. Consider your rebalancing schedule. If stocks have outperformed your target allocation, trimming winners and adding to laggards imposes selling discipline and buys lower relative valuations. For new money, consider dollar-cost averaging rather than lump sum investing when valuations are elevated. Spreading purchases over time reduces the risk of buying at the exact peak. Maintain your emergency fund and don't chase returns with money you'll need soon. Elevated markets mean elevated downside risk if conditions deteriorate. Review your investment policy statement if you have one. Does it still reflect your goals, timeline, and risk tolerance? Use this milestone as a trigger for that healthy check-in. Finally, extend your time horizon. The best returns come to those who stay invested through cycles. Market timing is notoriously difficult. Time in the market tends to outperform timing the market. If you're feeling anxious about elevated valuations, that's actually a healthy sign. Overconfidence at market peaks tends to precede the worst outcomes. Some caution is warranted. But excessive fear leads to missed opportunities. The market has a long history of climbing a wall of worry. Reasonable exposure with appropriate diversification remains the time-tested approach. So there you have it. Dow 50,000 is a milestone worth noting. But the real story is the broadening participation underneath that headline number. The shift from concentrated tech leadership to broader market gains historically signals healthier conditions. Whether that continues depends on earnings, rates, and economic fundamentals. Remember, this content is for educational purposes only, not financial advice. Consult with a qualified advisor before making investment decisions based on anything you've heard today. Thanks for spending these minutes with Money Moves Daily. If this helped you think more clearly about markets, share it with someone who'd benefit. Until next time, stay curious, stay diversified, and keep making smart money moves.